on a Oh my God, we're live?
We're live.
Made it.
Oh, KP, are you going to moderate or I'm going to moderate?
You know what? I think I can moderate for a little bit if we're still planning on having Brian chime in. If not, you can moderate the whole show because this is the Chrisman Commentary.
I'm going to have Courtney introduce herself here because we're very, very pleased to have Courtney. Question is, how long until I get a text from my dad saying, "Are you wearing a hoodie and smoking a cigar on a live show?"
I bet one minute or less.
1 minute.
1 minute or less.
No,
I like
actually,
what
you know,
time
the
that is.
fallacy of that is nobody can find this show on LinkedIn because it's all about Brian Views impressions. And so nobody actually like watches it live. So it'll take a little longer. But regardless, here we are. Welcome to Last Word, everybody, presented by Chrisman Commentary. Courtney Thompson, brand new. I tried to interview you for 8 minutes to see if you were actually qualified for the role about 13 minutes ago.
Yeah,
I didn't do much, but maybe you can introduce yourself to the general mortgage public for those that are consistent listeners of the show.
Yeah, absolutely. Hey, I'm Courtney Thompson. The joke is that I am a mortgage mutt. I bridged over from being a lawyer. That didn't work out for me very well. When your brain moves a lot faster, you can't sit in offices for a long time and write long things. So I've been in executive roles in the regulatory space, in the tech space. I am currently building a new mortgage servicing operation at CMG Financial, which is pretty cool. So the mortgage industry has been good to me.
You're killing me. Well, we'll do like the whole Professional Women's History Month in like a week or two here.
Yeah.
I told you what you see is what you get with me.
Yeah.
What do you like to do outside of mortgage? What are Courtney's hobbies?
See, I'm a woman. I'm a woman in mortgage, so all we get to do is work and be as smart as we possibly can,
And
so that we
wear
can.
a Canadian tuxedo. Yeah.
Yeah,
good.
absolutely.
Yeah.
Always.
What was the last time you smiled like ear to ear, like I'm having so much fun? What were you doing?
Oh God. I mean, all the time, every day. But because you're making a Canadian tuxedo joke, I'll say that I recently flew across the country to go see a Whitney Cummings show. Do you know Whitney Cummings?
I do. She's a great comedian. Little pale.
And
Needs a spray tan.
And she wears a lot of Canadian tuxedos. So it's what women in their 40s do to be cool these days.
So I think I asked you before we came on air because I told you my dad used to work at CMG, and actually I'd go into the office in the East Bay when it was there. Nice. Where are you based out of? And give us a little career background.
No, so I am based in Metro Detroit. I came up in Metro Detroit. Detroit was the big city that I moved to after law school to fulfill all of my hopes and dreams, and I've stayed. So the awesome role that I've been setting up for CMG is actually, we lost KP. Is actually to build a Metro Detroit based operation for CMG. So CMG's been doing this for a little while. They did it in Baltimore, and now we're doing it in Metro Detroit. And so we moved one loan to our servicing platform yesterday. And so it looks like everything is working. And so I was told once by one of my favorite mortgage sales guys, Don Klein, if you're out there, Don, that you can't celebrate until the fish is on the boat. So we've got a minnow on the boat, and we're going to celebrate later about that. But yeah.
Very nice. KP, the results The results are in. I got a text at 1:04 p.m. from my father, who's watching, and he's going to hear me say this. He says, "You're wearing a hoodie and smoking on a show looking for a sponsor, question mark."
What's
your response? What's your response?
If you build it, they will come.
There's a show for everybody.
I'm sure someone on the World Poker Tour will be sponsoring here shortly. I know. You're in the card room. Well, I gotta say, Courtney, I want to say welcome to the show. It's servicing has never been more powerful, I think, in our business than just in the last 2 years, because originations were down and people were relying on their books. And so the skill set that you bring to your company and to the industry, and I think, to this, podcast especially, I mean, I know you're not just servicing, you've done so much more, but it's a huge benefit to have you here. And so thank you for joining The Last Word with us, and Robbie taking over while Brian fixes his crashed laptop.
Can you guys even hear me?
We hear you.
Changed in your settings. Yeah. What? Yeah.
Guys, did I mention I work for a technology company? You'd think I'd have this stuff figured out.
Did you mention you look like you belong in Boca Raton when it's about 20 degrees outside in Detroit right now?
With like a Phi Sigma Epsilon t-shirt on.
That was your
you look great.
KP, were you at UT? I mean, we're both UT guys. KP, were you in I Felt a Thigh or I Tap a Keg? Which one?
Sadly, I was a Delta Chi. So we were, and I say sadly because we lost our house and our charter and everything, and hopefully they resurrect it one day. But it was a great run while we were there. Great, I guess frat, if you will. But yeah, I'm wearing my Star Wars tie-dye today. This is
that looks like a Scream painting by
that is like a stormtrooper's helmet or something. So my kids like it, everyone else hates it. But yeah, we're in Park City. We're wrapping up a family vacation. We've had 17 kids and 10 adults in this house, and everyone's gone, and we're out of here in about an hour. So just finishing up and ready to rock and roll. Anything going on in the world of the economy and rates and anything controversial? You know what? Let's throw Courtney right into the fire and let her lead. Yeah. Let her lead. Let her just say, this is what I want to talk about.
I feel like we should talk about the top 10% of what everyone is celebrating right now. There's been a lot of, I would say, large sweeping layoffs in Washington. I think that there's, if you take a measured view of it, right, nothing is ever as good or as bad as you think it is, right? I think that from a mortgage servicing perspective, and KP, thanks for giving a woot woot to the mortgage servicing community. We're all here, but in good times and in bad, we're still here. We're like a really, really reliable wife. I think that we do have to talk about necessary services at these governmental entities that will impact the economics of the mortgage environment if they cannot continue. I was at IMB, and Brian and I were there at the same time on the day that there was the sweeping order where everyone froze, and we were unsure about Medicare and Medicaid, and unsure about HUD, and unsure about a lot of activities that could come from there. And we have to remember that for better or for worse, a lot of these entities are still paper-based and still, really slow as it is in their paper-based environments to refund MSR owners, partial claims money, all expenses associated with servicing, approving foreclosures and foreclosure-related holds. There's a ton of servicing-related issues where we need bodies doing essential jobs. And I think it's something to talk about.
I also think in light of the LA fires that we've had, people are even more interested to know some of the intricacies about servicing. I had someone from one of the media outlets call me, and they just wanted to hear my take, and a couple actually. And it's interesting. It's basically it's kind of like forbearance COVID all over again. Everything's a case by case basis. Everyone's different. It's interesting to hear the mechanics of how servicers and servicing behind the scenes really, kicks off, especially in times of disaster. Fortunately for us, we only had one borrower impact in our portfolio, and it was just one. And what's weird is their house didn't burn down. Where they work, the building burned down, so they don't have a job. So the collateral land is still there. This person just isn't working. And so, of course, we're just trying to just give them a little break, a little forbearance break. But, I can't imagine what's going on for all the 12,500 homes that were lost in the area. I mean, that's a servicing nightmare. I don't know, Courtney, if you guys are dealing with that or not at CMG.
Yeah,
But
well, so we are almost dealing with it. We are launching CMG's new servicer now, presently, as we're going. We have loans at a sub-servicer today. I think from an industry perspective, if you didn't build a good infrastructure to catch this stuff after COVID, for shame, question mark. Now, I don't think that the industry did. I think that we are slow to learn lessons, particularly in, areas of companies that are not profit centers. I'm used to being an expense, and hey, I'm your cool, expensive hire. Yay.
Hey, hold on. How do we tie that into the reliable wife thing?
Right.
Yeah.
You got it. Wait, happy wife, happy life. Right.
I will say, reliable wives are expensive, and happy spouse, happy house. It goes both ways. Okay.
Yeah, there you go. Oh, see, I like that. See, look at you, just made it modern with your spouse house situation. Yeah, no, I mean, I think that there's a model for this, right? But if we were in COVID part 2, I would say that the top 10% is also really important because we have to have fast new rules to do things, right? And so I think that I don't know. I think that we're all in a wait and see mode with what's going on in Washington. But from a California forbearance perspective, I mean, the Lahaina fires are a good example where you have complete wipeout of an area, and the industry responded pretty well to that because, predominantly because COVID permitted the GSEs and the Ginnie Mae entities to provide 6 and 12-month forbearances, where previously it was 3 months and 3 months and 3 months. And if you're talking to 20% of your portfolio every 3 months to understand their individual financial circumstance, it's a lot harder than you can have up to 12 months, only take the months that you need, and then that there are solutions on the other side. What I haven't heard a lot of, which is something that I think that we should pay attention to, is that if you have COVID impact customers that are then impacted by natural disasters, they run out of solutions at a period of time because there's a maximum amount of payment deferral that you can have under most federal programs. Those are going to be one-off specials. I think that where servicers are stumbling the most now is not there. It's actually in this wave of assumptionness that we're seeing because of the longer term period that interest rates have been so high. There was a flush of assumptions for a period of time. CMG actually has a lot of VA consumers for one reason or another, so we see quite a few assumptions in that regard. There's not a good solution from a technology or an infrastructure perspective in mortgage servicing for assumptions, which are really an origination function. I would say that that's where the servicing industry is falling in terms of individual business processes.
I'm going to give a glimpse into my lack of knowledge, specific knowledge here.
Holla.
And I'm not wearing my CMB pin, so don't critique. So does
your pledge pin?
My pledge pin. Do assumptions require any agency intervention? So in other words, less bodies, does that cause a problem from an agency perspective in the assumption?
Exceptions, right? So exceptions to any of our processes in servicing are important. We actually had a loan last week. It was a self-employed borrower, and under the servicing paradigm, we couldn't get the self-employed borrower approved, but we had a wonderful LO out east who said, hold on, look at this. If you look at it this way, she can totally afford this circumstance. And I said, I completely agree with you. The sub-servicer is here. We brought it to the agency, and the agency is like, yeah, all day, all night, let's go. Right. Right. So that we don't have a repurchase event or other in the context of servicing. You do need, and again, please note, I said 10%. I'm not raging against the dying of the light here. I'm saying there are critical functions. And when we make big, fast decisions, we all need to understand that those critical functions might be at a standstill for a period of time until we reintegrate about what actually needs to be done, or spend money on getting rid of the paper-based processes at these entities so that we can have more automated, more digital, more risk-based functions and less human factor.
I'll chime in on that. So we don't at PRMG, we don't service everything that we originate. So let's just say, for argument's sake, between 10 and 15% on any given month. That means the rest, we're selling off to an aggregator where we just think like the price just makes more sense to sell them the whole loan as opposed to retaining servicing, especially if we think we're, at the high end of the rate curve here and rates are going to tend to go lower. Everything's going to run off later. That becomes someone else's problem, right? So I can't do e-notes, e-notary, e-closings, e-vaults, all the way across unless I'm 100% servicing all my loans. So it becomes a little, it becomes a little bit of a puzzle for us, right? If we don't service everything. And so I agree. We want everything to be paperless and everything. And it's just kind of hard to get there, in that environment.
I was having this conversation with a practitioner who's doing a digital whatever webinar later this afternoon and wanted to talk about this. And actually, John Hutchins on LinkedIn today posted same idea, which I think is really interesting, Kevin, which is, is the bang really worth the buck? Like this chatbot that somebody wants me to, or this AI that somebody wants me to invest in, does the business case make sense? And, from a mortgage servicing perspective, the shiz always rolls downhill, right? So we kind of have to service whatever's in our portfolio, whatever comes to us. So we tend to have more skills in the whatever space because it's just another derivation of what we're already doing. But, if COVID-19 wasn't the best use case for adoption in digital everything and servicing, I don't know what more the big players in this space need to see or hear to understand that consumers just want it easy for themselves in the context of mortgage, right? They just want to they want to be able to go to their loan advisor. They want to be able to get the right product, right? And then from a servicing perspective, it's like the Ronco food dehydrator, right? They want to set it and forget it. The chicken.
I like that. We're big food dehydrators here. Remote online notarization was such a pain just to get approved, and COVID was the impetus, and it still took forever for all these states to sign on, and it did give us some momentum. And I think this is kind of I think we all agree, like at some point we're going to be everything. I mean, hopefully. Most of it. And this, but this is the thing. I had this conversation all the time. It's like if I'm an originator, and some lenders think like originators are like, what? To give that good experience when the loan is already going to close and fund, and you're going to get paid whether they do it this or that, that's the decision that some people have to make. And so one of the things that we do is we try and calculate like, okay, well, how much time is being compressed by having an closing, an hybrid closing, and that works, right? And so it's a better experience. You're saving time, which means less time that I'm paying my closers and my funders, less time going back and forth with the originators. And so I think the industry is kind of grasping it and slowly getting there. But from a servicing standpoint, that's just the closing part. I think everyone kind of thinks that like an hybrid or closing is the right experience to give the borrower. But then beyond that, notes, storage, vaults, like all that other stuff, that becomes more of a servicing question. Who's servicing it, right? And so that's kind of where that little split is when I talk about experience.
I feel like you're going to be on AARP benefits by the time it's everything. I got into this industry in the early 2010s, and it was the end-to-end digitalization of the mortgage process, and we're still talking about it. And so I don't know how long. Granted, COVID was great, to Courtney's point, for pushing some of these things forward. I just wonder, especially, you guys talked about borrower experience. Yeah, all these companies are focused on it. Does an actual consumer know if I go to this company versus this one, I'm getting a better, there's no way for them to really know. And they're kind of locked in once I've submitted documents and I've had credit pulled and all that. Like, at what point does actual customer experience you're offering differentiate the customers that are staying with you versus they're going somewhere else?
I think if the realtor realizes that the experience was better for the borrower, that realtor will continue to refer future borrowers to that same originator. And that's where we're seeing the pickup. Their closing process is smooth. It's easy. Me as the realtor, I didn't have to do that much. They do this hybrid closing thing, and so it helps for future business. I think from a originator realtor referral relationship standpoint.
Does that make you want to target more realtors in your marketing outreach, or you and I have talked about a platform where realtors are the target rather than borrowers because they're doing 5, 6, 10 transactions a year versus borrowers once every 7 years. Do companies start focusing more on realtors to fulfill this customer experience journey that they've spent so much time,
Yeah. Yes. I think originators overwhelmingly are still getting deals from realtors. I mean, on the purchase side, I mean, overwhelmingly, it's still, it's a ground battle. It's a ground game. It's hand-to-hand combat in the streets. And so, if you're armed with an e-hybrid closing tool, that could be the difference between you getting a deal or not. So I still think, unless we get back to a refi boomlet or any kind of uptick in refi business, or maybe people get a little bit more serious about, equity lending, for just like a second lien or HELOC or HELine or HELoan or whatever. I still think purchase business is where it's at. And, it's a grind right.
My last interjection here, because I know you guys have much more valuable things to say. Are you seeing that come to fruition yet? When, are we there where real estate agents are referring business one way or another based on experience? How long until we actually really get there?
I think it's all based on that, right?
It's happening though. Like right now, you feel like it's differentiating.
Yeah, but it's experience in a very general sense, because if I'm a realtor and I referred somebody to a loan officer or a lender and it blew up and it was a terrible experience, who's the consumer going to ultimately blame? The referral source who pointed me in that direction. So that's been the playbook forever. It's just a different flavor of experience that we're talking about here. This is a little more nuanced experience around technology. I happen to think the E experience needs to convert to $sign and have that impact for the consumer, and then that's what's going to drive consumer engage. The consumer decision.
Courtney, do you guys survey your servicing clients? Like, we survey loans in process and then post funding, and they're overwhelmingly 5 stars. And of course, if there's anything less than perfect, everyone on our team, including myself and our owners, we all jump all over it because we want to make the experience better for the next person. Do you guys do surveys for people how's your servicing going?
I love that question. I love that question because I have had the honor and the pleasure for the last 18 months of building a net new servicer with technology that we selected under a specific strategy up front, right? When you're not buying an old shitty shop and you get to actually build a mortgage servicer the way that it should be, if you can, in 2025. So with available technology, right? Not new technology. So configured available technology, 100% KP. We will be surveying every single customer as they get off the phone, because we're going to be in a modern environment where we can deploy some of those tools, right? We're going to have sentiment analysis. We're going to know on the phone at the time that it's happening if a borrower gets mad at an individual agent so that we can escalate it along the way, right? We're going to have real-time transcripting of everything that we have so we can do word search, term search, issue search, if we're starting to see, the things that you can do in call center land, if you're setting something up in a modern environment. Really, the goal is uncall center, but we can save that for another 30-minute circumstance. But if you're not asking those questions to the customers, and I would say particularly in interim servicing, I think interim servicing is a real interesting nut. You probably have some of these woes, where you are. New customer, how do I make my first payment? What do you mean that I'm going to go to another servicer after I make my first payment? I just want to set it and forget it. And that's the majority of customers these days, right? And so if you're not asking those questions, I think it's a problem. Unfortunately, the problem is that I think that the rest of the mortgage servicing industry, or a lot of them, and maybe they're fibbing to you if they say that they're not, are still on the defensive in terms of even being able to produce the right reports out of their system to know what's happening in their processes. There's still a lot of servicing processes that are off the grid, namely the complaints management process, because it's a post-Dodd-Frank new regulatorily required process that wasn't contemplated at the time that these big box technologies were created in 1968, 1972, and 1985. But, we can, and I digress.
Did you just run through all of our birth years?
No, but that's awesome. In there. My Botox program is better than that.
Might happen to be the earliest one, just so everyone can be aware.
Yeah. I love the idea that you guys are getting surveys midstream, or, for an origination, it's like, you start disclosure and then you're funded, sometimes in 7 days, and sometimes you're funded in 45 days, just depending on the loan program. And so we do like one kind of check in the middle, how's everything going? That way, in case there's a real problem, we nip it in the bud. as opposed to after we close and fund and then they go blow us up. And Google reviews, reputation, management, it's all part of it. But yeah, we don't really do anything. I mean, even when we have, Cenlar is our sub-servicer for the loans that we do retain, and they kind of handle their own, I guess, surveying, if you will. So we don't really, from PRMG corporate, we don't get into the experience post funding, unless it's like, they're pissed off and they missed a payment or something, and we got to figure it out. But we don't really hear about them after the fact. But we still drip on them, right? I mean, we still drip on them. We've got CRMs, we got post-closing stuff. So it's not we don't talk to them. We just don't talk to them about the servicing experience because we're like, we're not worried about that. It's handled. So it's good to hear you guys creating the transcripts and the modern stuff and the AI, and you got to use it all nowadays. So,
KP, I have a quick question for you. How do you determine what servicing you release versus retain? I mean, you're at that.
It's typically execution, but also product. So, like for example, if we want to stick our neck out and do stick something in our Ginnie Mae book for a very tough manual underwrite, where we believe in the file, our underwriting believes in the file. I mean, that's not the overwhelming bulk of it, but there's some overlays out there that people just won't buy, and so, but it's also just a good measure of note rate. The lower the note rate, the less likely it's to pay off.
What you just said sounds like there's a large qualitative aspect to it. Are you saying you're taking this? Yeah. Okay.
Yeah, I mean, aggregators go in and out who we sell to on price, so we want to keep them in check and go, we don't like your price, we'll just take care of ourselves. And by the way, during COVID, for the audience, no one had enough money, right? So I know we didn't get into GSE conservatorship release here as a topic today, which I'm totally against. And I mean, I'm just against it. Unless there is an explicit congressional guarantee, which is what the NBA is lobbying for. But if everyone remembers during COVID, when shit hit the fan, nobody had enough money to backstop this industry. So people that we sold our loans to, they were protecting themselves. So there's no one had enough money, period, full stop. And so we decided, like, we have our own money, we might as well just service everything. And so everyone just had the, you didn't know like how much you're going to have to pay for taxes and insurance or principal and interest or what's forbearance or how long is it going to last or how much do I need to take care of all this. So, we're nobody, but we ramped up a $12 billion portfolio, which was nice. And, we did it with our own money. Thank God to, Paul and Robert and Gary, my partners, we all, pitched in and made it happen. So, I just not to go too far, but Robbie, to kind of get into it, nobody has enough money to backstop this industry except the U.S. government. And the next pandemic, and it will happen, or war or whatever, they're going to have to step in. And so if Fannie and Freddie are private and there's no explicit guarantee, from Congress and this release of the GSEs out of conservatorship, what is that going to do to MBS prices going forward? You think trigger leads are, bad for servicers, or they may have to price in higher, risk because they can't retain it. How about not knowing that the government's got your back? And I hear the counter argument. Of course they have their back. They always step in. If it's not in writing, the bond market and traders have told the MBA.
I'm waiting for Trump to order Jerome Powell to start buying mortgage-backed securities by the boatload again. Rates are going to go down. Refi boom. It's going to happen. We're out of time. All right, got to go. No.
Well, if it were only that simple.
I want to pull this back to servicing and customer experience, and then also tie it in with today's Chrisman Commentary, right? Which I read every day, promptly, usually around 7 a.m. I think it was a little slow today, Robbie. You were slow on the button. In the opening, the commentary
card game.
The opening talked about the PETA impact, right? For originators that sell loans to aggregators, typically you've got the pain in the neck factor. So I'm gonna add a quarter or 3/8 or even half a point to the execution because they're just tough to deal with. KP, probably more for you, but Courtney, I'd love your thoughts on this. How much does the servicing experience of your aggregator come into how you think about best execution? In other words, if brand ABC is just lights out better than anybody on price, but we know their servicing experience for our consumers is less than okay, do we put that into that best execution, that PETA factor at all?
KB wants to hear from you.
Yeah, KP.
Well, No, we don't. I mean, we don't ding anybody for being a P. We have different tiers and pricing and correspondent for pull through and volume.
I'm talking about the other way though. I'm talking not who you buy from, but who you sell to.
I mean, they may do it to us. I would say pretty much everyone we sell to is fine. I mean, we don't necessarily.
KP means more if you're going to retain them later on. How much do you care about who you're selling the servicing to for the overall experience of working with PRMG?
Well, let's just say that I have 5 different outlets. He's asking, do we put a tax on someone we sell to because we don't like selling to them because they're a pain in the ass? So, that's what he's asking. And the answer is no. I mean, we really do try and do best X. We pick partners that we feel pretty good about. I mean, do we put someone in the penalty box? I don't really think so. Gary is not that kind of guy. So, good question though.
Yeah, I think that they always follow the money first, and I'm just saying I'm generalizing a large group of people that move these things around. Money first, but I would challenge the servicing industry to explain why your process, or the subservicing industry to explain why your process is that much better than anybody else's. And if anybody would like to run those facts, you want to fact check that, just DM me on LinkedIn.
Love it. Courtney, thanks so much. This was awesome having you on for the first ride. We'll make this a little smoother going forward. I'll fix my tech next week, but
it's okay. I was just hard and feathered without you in the first 5 minutes. It was cool.
No, you were great, Courtney. I learned a lot today, and there's this battle raging between originators and servicers, right? And it's really good to hear the perspective of how both those two can come together and be more aligned. So I learned a lot today. Thanks, Robbie.
Robbie, thanks for sharing.
I'm the court jester. KP and Courtney are the people with real insights. So thank you, KP and Courtney. Y'all are great. And Brian, for all the effort you do on the show, I really, really am appreciative.
All right, y'all. We'll see you right back here next Friday. Hey, housekeeping, if you want this on your recurring weekly calendar, DM your email address to me and I'll add you to the calendar. Rob and BK and Robbie are going to add some another mechanism for you to make sure this shows up on your calendar the right way. Look for that in the next week or so. So see you all next Friday. Have a great weekend.
See y'all.